To keep modern artificial intelligence running, you need an immense physical footprint. We're talking acres of industrial server racks, millions of GPUs, and massive cooling systems that run around the clock. For the past 2 years, financing that infrastructure felt easy. Venture capitalists and institutional investors were practically lining up to throw billions of dollars at any startup that promised to build the next generation of data centers. But this era of unquestioned, limitless funding has hit a wall. To understand why, we have to look away from Silicon Valley and check the temperature on Wall Street, where the heavy-hitting institutional lenders operate. This week, several major AI-linked borrowers tried to tap these lenders for cash. The most prominent was CoreWeave, a cloud infrastructure provider that went to the market seeking a $2.6 billion loan. Instead of finding eager checkbooks, they ran into a wall of investor fatigue. Lenders balked at the terms, forcing the company to offer higher yields to get the deal done. So what exactly is the smart money in the debt market seeing that the tech hype machine is missing? These institutions are running the math and confirming a growing fear, the risk of an AI bubble. The leveraged loan market operates without the optimism of venture capital. These lenders trade massive sums of capital for guaranteed, predictable cash flow. When lenders sense instability, they demand sweetened terms to justify the risk. As risk premiums expand, yield percentages spike, a mathematical tax compensating for uncertainty. Lenders also use discount pricing, forcing AI companies to accept less upfront cash than they must legally pay back. Because of these shifts in the loan market, financing the physical expansion of AI data centers is suddenly becoming significantly more expensive. Wall Street lenders are demanding these harsh terms because they are watching 2 major warning signs across the AI industry. The first red flag is collapsing profit margins, and it is being driven by the industry's biggest players. Effective at the end of July, OpenAI slashed prices on its GPT 5.6, Luna, and Terra models, dropping enterprise costs by up to 80%. While cheaper models are great for users, they worry lenders. It signals a race to the bottom for enterprise revenue, which makes it harder to guarantee that these companies will have the steady cash flow needed to pay back a billion-dollar loan. The second red flag is coming directly from federal regulators. The government blew past its August 1 deadline to establish an AI framework. They failed to publish rules from key agencies, leaving crucial definitions like covered frontier model completely blank. Without these definitions, labs cannot determine if their next models will face strict compliance oversight or legal liability. To avoid that risk, several companies are stalling their internal release timelines until the government provides clarity. Plummeting consumer prices combined with this regulatory limbo creates a risk profile that debt markets are refusing to finance cheaply. The flow of cheap, easy capital that fueled the artificial intelligence boom's first 2 years has effectively stopped. As the cost of borrowing capital rises, it acts as a speed limit on how fast new models can be trained and new data centers can be built. With the barrier to entry rising, future innovation may be restricted to the handful of megacorporations that can afford Wall Street's new premiums. The industry is transitioning from a hype phase built on venture capital optimism into a maturation phase. Having superior technology or a talented engineering team is no longer enough to secure the funding needed to scale. To convince skeptical debt investors to cut a check today, companies must prove they have an immediate path to near-term profitability. The bond market's demand for near-term returns has become the primary ceiling on how far and how fast the AI boom can go.